In this video, we'll calculate the precise break-even points for debit and credit spreads. Unlike the single-leg options we discussed in Phase 1, spreads involve two contracts working simultaneously, which alters your zero-profit line. Your break-even isn't simply the strike price plus premium. It is the specific price level where the intrinsic value of your position equals the net price paid or received. Understanding this exact level is crucial for determining your true probability of profit before entering the trade. Let's start with debit spreads, such as a bull call spread. Since you pay a net debit to enter, the stock must move in your favor enough to cover that initial cost. The formula anchors on your long strike. You take the strike price you own and add the net debit you paid. If the stock doesn't rise past this total by expiration, the trade yields a loss. Conversely, credit spreads, like the bull put spread, work differently because you receive cash up front. Here, the credit acts as a buffer or cushion against the stock price. To find the break-even, we anchor to the short strike and subtract the net credit received. The stock can actually move against you slightly, but as long as it stays above this calculated level, the trade remains profitable. It is vital to distinguish between call and put spreads when applying the math. For call spreads, whether debit or credit, you generally add the premium to the lower strike. For put spreads, you subtract the premium from the higher strike. This relationship holds true because calls derive value from upward movement, adding to the strike, while puts derive value from downward movement, subtracting from the strike. Memorizing these anchor points allows you to assess risk instantly without relying on your broker's P&L graph. If you know your break-even is $102.50 and the stock is at $102, you know immediately that despite the bullish trend, the position hasn't yet covered its cost basis. In our next episode, we will apply these break-even points to calculate risk-to-reward ratios. Next, we will use these numbers to calculate maximum risk and reward.